First rates will just start coming up on your screen. There you go. Nifty up. It's a flat start, but the positive start, which is what is important. That incrementally you are ignoring what's happening in the world. For the Nifty, it's again a flat start with a positive buy. There is more green on the screen. I think that is what really mattered directionally. I want to look at some newsmakers here. Tata.com reacted to numbers yesterday. ET Now impact, the stock was a 4-5%. Is there another ET Now impact there? Well, the stock now seems to be settling. In terms of volume activity, you've got Rail Vikas Nigam. It's right up there, 1.1 million shares already. You got Indices, you got Yes Bank, which is giving it some company 1.5% higher. Zomato, ICICI approved the scheme. ICICI Prudential, AMC has checked in. They bought 1% plus equity. But then HCL Tech, I think, is the one where the surprise is. It's bouncing back because there was too much of bearishness in the market, and HCL Tech is reacting to numbers up 28 rupees. That takes it to 1066.
Okay, couple of other names, and I think LIC has got to be the rank underperformer today and the biggest disappointment. Let's bring up that stock up for you. 0.6% lower, 548 is where it is struggling. There's also Sterling and Wilson, considering the losses have only expanded to about 417.5 crore rupees for the quarter gone by. 6.5% is the kind of gap down that you're seeing on Sterling. Of course, HCLT is seeing an earnings reaction. SBI Life, their March premium is coming higher by 23%. Retail AP is up 12%. The Scient we just highlighted, the guidance is in line with estimates. ICICI Pru, the Q4 analyzed premium is higher by 26.5%. VNB margin at 32%. ICICI Pru holding up 1% as we speak right now. Max Financial, the life March premium has come in higher by 43% and retail AP up 60% or so. RVNL once again, along with the JV of Siemens, has bagged 2 orders from Gujarat Metro Rail, and Siemens share stands at about 678 crore rupees in that. So let's bring up that stock as well for you, while RVNL is holding up 1.5% as we speak. Siemens was just come for you on your screens as well. Oberoi Realty, the Q4 booking value has been marked at over 6,000 crore rupees versus 925 crore rupees that they saw. The area booked stands at now 1.4 MSF as clocked in the fourth quarter. Oberoi Realty now nudging around that 900 rupees per share mark. There's Finolex Cable as well. They've announced a capex of about 290 odd crore rupees. Prima facie, these are a bunch of stocks which are in focus right now. For the index though, it's once again a very, very quiet start. Your big star performer today, hands down, that's HCL Technologies, 2.8% higher there. There's Idea as well, which is holding out well. Jubilant Foodworks, by the way, is up 1%. Ramco Cement is holding out well. And then HDFC Life as well, which is up 1.5% as we speak right now. But Kunal, along expected lines, quiet index, what trades are you punching in?
A quiet index, again a good start index because the market breadth is still a lot more positive and healthier. The stock which I would look to trade in the open would be SBI, because I think that stock is now nearing towards a break of a psychological as well as a strong resistance around this 550 mark. Last 2-3 days, the momentum has been very strong for SBI, so that's a stock which I would look to trade with.
All right, Naresh, let's get in a sense as to what you're punching in this morning as your first trade. Unmute yourself, Naresh.
Adding up to the position on IDFC Limited itself, the stock is setting up for a breakout move. So, like the stock for a move towards 90 in the short term.
Let's hear out from Atul Suri then from Marathon Trends PMS. He believes that if you get your thematic bets right, 70% of your investments are in place for the year ahead.
That sectors or themes, because we look at themes and we think 70% of your work is done if you get the theme right.
True.
Right? So we find that electrical equipments,
okay.
engineering,
okay,
these are sectors which have been decadal underperformers.
How much weightage do you think one should have? For example, if we use Nifty as a benchmark, 35% is financial. So you need to stand somewhere closer to it.
Right. You don't have to.
I mean, that's what fund managers do, right?
Yes, but I am not.
Okay, that's what
I'm underweight. In fact, shockingly,
underweight
there's
financial.
consensus bullishness on banks. We have banks, but they're more commercial facing.
Yeah.
They're more commercial facing, so we feel that that is where the move is. So even if the banking moves with a lower weightage, we will get a bang for a buck because we feel that we are in the lighter space. We actually favor industrials, commercials, hardcore infra, capital goods, very different from themes and sectors that dominated the last decade.
So how do you decide the
Metals?
weightage then? I mean,
So as I said, our largest weightage is electrical equipments.
how much is that? Would be
We have about 15-16% there. We have about
15-16%.
But
Yeah.
Atul, that's not an index mover, right?
In fact, as a portfolio manager, my job is not to hug the index. If I hug the index, I am not adding value. Then a person may as well go into a passive fund,
Yeah.
an ETF. My presence or my value is only if I can create disassociated outsized returns. And that would come by not hugging the index. So we really do not try to hug the index. And that is why you will have sector bets like, as I said, electrical equipments. I think engineering is another very interesting space. Defense is another interesting space. These are sectors and themes which may not have weightages in the index, but we feel that these are stocks and sectors making new highs. And that is what will create the alpha going ahead, and that is where leadership is. So that's why I've been emphasizing that not much is happening on the index. If you're an index hugger, there's not what happening. I mean, if a Reliance goes up, Infosys comes down.
Yeah.
And if a L&T goes up and ITC
Seesaw.
goes up, something else is going down. So net you're setting off, but in that, so there are a lot of opportunities, sectors and stocks are doing well. And as and when we come out of this grip, you will find that leadership will come here. And as I said, that ultimately they have been decadal underperformers. They are under-owned.
Now also you feel like
I feel so. I feel that if you look at weightages per se, people have not even got to at par levels. And that, from moving underweight to overweight, when the trend or when the movement happens there, is I think a great opportunity and will give a lot of momentum to these spaces or these sectors.
So if you have to, let's say, talk about the strength in some of these stocks.
Right.
Do you expect them after a decadal underperformance to be an outperformer for at least 3 to 5 years? And we are at the beginning of a multi-year or a multi-quarter outperformance in cap goods, engineering and electrical stocks.
I think so because we saw that last year.
Yeah.
Right? Look at PSU banks. I mean, last year the index was flat, 3% positive. At a PSU index went up 70%.
Yeah, 30.
So what really happens is that sectors that have underperformed for so long, people naturally get underweight. And sectors which have done well, people are already.
Now, Mahesh, good to have you back. How are things? Haven't seen you on the channel in a while.
Hello.
You could hear me. Hi, Mahesh. Is my voice reaching you?
Yeah. Good morning.
How are things? Haven't seen you on the channel in a while.
Yeah. Things are fine. Yeah, doing great. Yeah, markets are also fine.
Are they fine? Because last 2 years the returns have not been fine.
Yeah, last 18 months they have been flat, but I think it's gone through a period of consolidation, right? And earlier, I mean, there was concerns that the markets valuations were expensive, right? While growth was good. I think the good thing is that the valuations are now corrected to more reasonable levels. There is some concerns about growth slowing down, earnings downward, but still I think we are in a period where we're seeing decent earnings growth, at least in double digits even next year. And I think a lot of the fears about high inflation, interest rate hikes are now kind of looking behind us. So I think while the market might not do too much from a short-term perspective, I think it's creating a good now kind of a support for making the next move or a medium to long term.
Mahesh, what could be the trigger here? Because earnings are not exactly expanding. Metals are numbers have topped out. IT numbers have topped out. For banks, base effect has kicked in. So, are we really in for a good earnings trajectory?
Yeah, I think while there have been some disappointments, I think we saw in the IT sector there was disappointment which was kind of expected, but not to that extent what we're looking at. And there is some slowdown in the consumer discretionary side. I think the numbers have been mixed, but by and large, I think if you look at there have, like for example, if you large sector, like for example, banking and financials numbers, very few numbers have come out, but look to be fairly on track over there. Even in sectors like domestic engineering, capital goods sector, numbers look good. Even in cement, I think you should see improvement from what we saw in the previous quarter. And amongst the global cyclicals, even metals, okay, where there have been, I mean, last quarter was a very bad quarter. There also, sequentially, we are looking improvement in terms of the pricing environment now with China opening up. So I would say that by and large, even for next year, even after the numbers what we are coming, we've seen around just about 2 to 3% downgrades to earnings. I mean, earlier the earning expectation growth was around 16% or so. That will probably be around 12-13% in that range, which is not bad in the current context where we have seen global growth, especially in the developed markets where the growth is more or less flat.
Mahesh, every large fund has a overweight on financials. That's one space where growth is visible. That's one space where NPA problems are not there. But when we speak to the top bankers in India, Axis Bank or SBI, all of them are talking about a moderation in FY24. Are markets prepared for a moderation in credit growth or profits?
You're right. I think because I think while the GDP growth might not, in real terms, might not come down so much, but in nominal terms, okay, there will be a quite a bit decline because the inflation, which was especially WPI, which was driving nominal GDP growth very strong, I think that will come down dramatically in FY24. So we're expecting nominal GDP growth to be actually somewhere in the high single digits, right? And to that extent, credit growth would also normalize. But I think to large extent, I think I would say that is factored in because if you look at the valuations, okay, in the banking space, they are not really demanding. I mean, most of the banks will probably be near the long-term average or slightly below that. And mind you, I think overall the profitability trajectory for the banks is much better than what it was during the pre-COVID levels. So both the ROAs, the NIMs, while NIMs could see some kind of a impact as the transmission of the benefit of the increasing the interest rates. Initially, you benefit on the asset side, but as the liabilities cost move up, you will see some compression over there. But despite that, I think we expect overall NIMs and the ROAs to be much better than the pre-COVID level. I think that would probably justify better returns or better valuations for the banking and financial services sector. And to that extent, I don't see much of a concern. I think markets are already starting talking about a lower nominal GDP or credit growth, which is around, last year was around 15-16%. We're expecting that to be around 11% or so in FY24.
I'm curious to find out what is it that you've done within your funds when it comes to IT? Because, you know, most funds have ownership within the IT pack, and especially after the disappointment that TCS and Infosys have been, have you reduced weightage there?
No, we have not done much. Actually, we were slightly underweight the IT sector. Okay, we were not too negative also on the sector because we think that this is a kind of a transitionary period. Over a medium term, we still expect the sector to do reasonably well with good cash flows, with good earnings yield. We don't see much of a downside over there. Obviously, the growth is missing, so it's not exciting sector really to be in. But there are challenges across various sectors. So given that we were slightly underweight, and we continue to maintain that, I think post the recent correction, what we have seen, now I think the stocks seem to have actually bottomed out, at least from a valuation perspective. Okay, now it's a question about what the earnings growth is going to be. And here again, I think we are seeing some kind of a divergence there. I think it's a few companies recently reported are showing reasonably good growth or probably meeting their guidance. There have been some disappointments. So we'll have to wait and see. But I would say that I mean, at this point in time, we are kind of neutralish on the sector. We're not really too negative because valuations are already now corrected to levels slightly above the pre-COVID levels, but really factoring in some of the slowdown which is expected.
Interesting. Any contra calls that you may have in this current market, especially after the fall up until March 29th and the recovery thereof? For instance, one is seeing FMCG, pharma kind of sectors make a comeback.
Yeah, so I think in contrary sectors like consumer discretionary, consumer durables, retail, we have seen marked slowdown there in the last quarter and possibly in this quarter also. There has also been a meaningful correction in some of these names, which were quite expensive earlier. I think structurally, I think India, we expect discretionary consumption to increase as a percentage of total consumption because of the rising per capita income premiumization, which is happening. And this could be a good opportunity in this correction where the numbers are likely to disappoint to look at that sector from a longer term perspective. Pharma is another sector which has kind of underperformed after rallying after the post-COVID wave. We have seen numbers kind of disappointing, especially in the US generic space. Again, there also what we hear is that the pricing pressure which was there in the US generic space is slightly easing off. There is still price declines, but the pace of decline is now reducing as there is some amount of consolidation happening on the supply side. So I think that again is a sector which can be a good counter of all, considering the fact that there are also the valuations of the large companies are fairly reasonable compared to their historical averages.
Let you go on that note. Appreciate you taking the time out, Mahesh, and joining in, sharing with us your outlook on the markets. Let's move right on then and connect with the management of Scient to discuss the good quarterly set of numbers, what the outlook is when it comes to growth as well as revenues. We've got Karthik Natarajan, who is the ED and CEO at Scient, joining us on the show. Mr. Natarajan, thank you so much for taking time out. Overall, it's been strong when it comes to your earnings, but I think that big surprise came in the margin. So what really led to that margin beat, and what are the levers for that 100 to 200 basis points margin expansion in FY24?
I can tell you that I think we have been bringing a lot of factors over the last couple of years in terms of operational efficiencies in the form of utilization, pyramid correction, and also ability to improve on our price hikes and automation. And all this combined effect helped us to improve the margin in Q4. And also with increased offshoring, we have been able to improve the offshoring by 10% over the last 10 quarters. I think that also helped us to improve on the margin. And we continue to use some of these levers to play out for us in fiscal 24. We also talked about some of the G&A rationalization about 6 months ago, and most of the plans are on track. And we hope that will also help us to improve the margin for fiscal 24.
Sure, Karthik. So how are your various verticals doing? And would you say that transportation has bottomed out? And what about communications?
Yeah, I think that's what we guided. We said all our businesses, we have a very balanced portfolio. So if you look at, we have transportation, connectivity, sustainability, and new growth areas. And most of them are between 35 to 52 million in terms of the quarterly run rate range. So we are very comfortable with our portfolio, and we do feel that each of the business units can grow by themselves. And that's what we are really excited about. Specific to your question on transport, I think we had been talking about it for the last 4 to 5 quarters, and we have seen aerospace has been growing consistently. And in Q4, it has probably showed the highest growth of more than double-digit quarter on quarter, and which is really something that will continue in the form of growth into double-digit for the full year in fiscal 24. And we are very comfortable with our portfolio growth for fiscal 24 too.
Well, order intake came in at $200 million. Could you walk us through the way forward?
Yeah, so I think we have talked about the order intake for the last 3-4 quarters. We always consider a year-on-year number would be a right number to compare. So if you compare Q4 of fiscal 22 versus Q4 of fiscal 23, we have shown a 19% growth in constant currency. And for the full year of fiscal 23, we have shown our order intake growing by 18.5%. So that is kind of an early indicator for us. And we also have seen a growth of 10 million plus, 20 million plus accounts on an annualized basis, which shows the kind of mining efforts that has been helping us to really move the blocks from 2 to 5 million to 5 to 10 million to 10 million plus customer accounts. And also combined with large deals. And we have shown about 418 million large deals for the full year. I think these are the early indicators that I would really take a view when we really started looking at our guidance of 15 to 20% year-on-year services growth.
All Now, given that, you've been associating closely with a number of clients, what's been the reading of the client behavior? How different has it been from, say, 6 months ago? Have you witnessed any ramp downs?
Yeah, macro uncertainty still prevail, and with the higher inflation and interest rates, we hope it cools off during the later part of the year. I think there is still a hope. And anything which is related to the consumer tech or consumer electronics or semiconductor will see softening. Luckily, that business is less than 10% of our portfolio. So we are confident about some of the verticals that really badly hurt during pandemic. I think they are recovering back, and that is going to really play out well for us. And we have also talked about some of the mega trends and which are still intact, be it in terms of sustainability, intelligent products and platforms, and digital, and really driving significant transformation on technology solutions. I think those are intact, and we are confident about the portfolio that I talked about, and also some of the investments we made both on digital and technology areas.
Sure. Scient DLM wanted to understand what then is the growth outlook, the timeline of IPO?
No, we have already filed for DRHP, so we are on a quiet period now, so we won't be able to give any forward-looking statement on DLM. And we are hopeful that sometime this quarter the IPO should happen.
The other thing I also wanted to talk about, Karthik, is your commentary on your railway vertical. What is it that you're seeing there, considering the kind of huge order inflow that we're seeing here within at least the domestic circle?
We have stopped providing individual sub-businesses, and we are really talking about as transport, which includes aerospace as well as rail. And we guided that we have hit our bottom in Q3 of fiscal 23, and we have recovered very well in Q4, and which has grown more than 4 to 5% quarter on quarter. And we expect that momentum to continue into fiscal 24. And for the entire transport business, we are confident about driving double-digit growth for fiscal 24.
Headcount addition target for FY24, where does that number stand?
Yeah, we talked about this. We have added about 509 heads in Q4 of fiscal 23. And we have also dropped our utilization by 3 to 4% with net addition of headcount. And we are fairly comfortable with both our utilization levels as well as the net headcount addition that we had. And we believe it will be similar to what we have done in fiscal 23 for fiscal 24.
All right. Thank you so much for taking time out and joining in, giving us a view on the business metrics. So they have said that double-digit growth in key verticals can be expected, and that we are likely to see an improvement in the second half. Confident of digit growth as well in the transportation vehicle, but acknowledging that the macro uncertainty still prevails. Take a look at the stock of Scient, though, a clear thumbs up, 6.5% higher in trade. All right, let's slip into a very quick break then right here on the show. Be right back.
IT is coming back, and what's interesting here is that within mid-cap IT space, now it's not like everything's got bombed out. Mastech yesterday, it recovered because everyone thought that UK and Europe is only going to go in a downward spiral. Mastech comes out, they show recovery, they talk about growth, they give a decent guidance, the stock just goes through the roof. You just heard the management of Scient. They've also done rather well. It's a mid-cap IT company, up 6%. So it's not that IT is game over. IT is going through a cyclical patch of downturn, and typically when you see a large sector going through a downturn, the general assumption is that every IT company will face the heat. No, it does not happen like this, because in last couple of years, Indian IT sector has got a lot of various sub verticals. You've got engineering specialized companies like Tata Elxsi. You've got pure IT services companies. You've got companies which essentially are in the business of high tech like Emphasis. So within the IT space, while engineering and coding may be the same remote part, there are a lot of niche pockets in that where I think the differentiating part really needs to kick in. I mean, Emphasis today is not going anywhere, but Scient and Mastech post numbers, they're doing rather well. HCL Tech is bouncing back because the guidance was not that bad. It has only got like 1.5% to 2% EPS downgrades for FY24, unlike Infosys, which has got on an average EPS downgrade of about 15%. That's a nasty number. NS Kannan joins us now, Managing Director and CEO with ICICI Prudential Life Insurance. Let's connect with him to understand that how things have progressed for the quarter gone by. Now, you've registered a strong growth this quarter. Your NBP is up 18%, your VNP is up 36%. What would be the levers to ensure sustainability?
You asked about this VNB development. While you have pointed out correctly that the VNB has grown at 36% year on year for the fourth quarter, what we are particularly happy is what we delivered on what we articulated 4 years back. You will all remember that 4 years back, we said that we want to double our financial year 19 VNB in 4 years' time. And I'm happy to say that for the financial year 2023, we have actually more than doubled our VNB. So that has been the key highlight of our VNB performance. And if you look at the year as a whole, the VNB has grown at 28%, much ahead of the estimates. So that has been the highlight of our performance. You talked about what is the outlook given this. I believe that underlying the delivery of VNB, there has been a lot of work done on diversification of our platform. By platform, what I mean is that be it the product suite or be it the channel diversification, we are much more granular today compared to what we were 4 or 5 years back, with adequate representation in the mix of linked products, non-linked products, protection products, annuity, and so on. And similarly, on the channel, there is a well-diversified channel mix we have today. So given all this, I believe that we are well positioned to further grow our VNB, given the insurance potential and the regulatory developments in the country. So that is how I'll summarize the results for this period.
Right. Your premium growth over the last few years, especially from the banca channel, has been a bit of a concern for shareholders. Do you think this is likely to change going forward?
Yeah, the way we looked at is that we are one of the well-diversified channel companies in this space. So what we have for a bank-promoted company, possibly we are one of the most well-diversified within the banca itself across all the companies if you look at. So if you look at our banca constitutes about 30% of our business, with the agency constituting about 26% of our business. So growth concern you talked about, the way I look at it is that to split between ICICI Bank and non-ICICI Bank. As you all know, ICICI Bank has been focusing on the banking products, not so much on the third-party products. Given that obviously the consequences are that the ICICI Bank growth rate has come down. It is in the public domain. We have seen a 38% decline, for example, in financial year 2023, year on year, in ICICI Bank channel. The other channels, if you look at other than ICICI Bank, we have actually put out a very strong growth rate of 28%. Even if you look at on a 4-year time period, non-ICICI Bank channel growth has been at 18% CAGR. So there should not be any concern whatsoever regarding the growth. And specifically, if you look at the Q4 of our performance, there has been a very solid growth in terms of our APE, and we have actually grown with ICICI Bank together. We have actually grown the APE at 27% year on year. So it's a solid platform, and the growth has come back very strongly. And particularly, I will point out that in the fourth quarter, the retail protection, which has been a bit across the industry during this pandemic period because of various factors, especially supply side factors, that has come back on track. We have actually seen a 28% year-on-year growth in retail protection alone. And as you know, it's a great product from a customer perspective in terms of fulfilling their protection requirements. And from our perspective, it's a high margin product. And given that the base is low, that is also going to give us a huge growth in the VNB going forward. So I think there should not be any concern whatsoever on the growth of the company, not only on VNB, but also on the top line.
Fair enough. What about any major changes in the product mix that you've witnessed in this quarter? Anything specific, any new products that you would like to introduce in FY24, especially in light of the recent changes in the budget on the high premium policies?
See, the way we look at this high premium tax, etc., is quite different from probably some of the other players we look at in the industry. We do believe that we should have a product range to meet the needs of the customers. That is our primary plank, not on arbitrage or anything like that. There could be some arbitrages in the short term. There could be some policy things in the short term, which we should be taking advantage of in terms of having a base to take advantage of such situations. But beyond that, our focus is on meeting the needs of the customers. So we had put out some time back in the public domain that this high ticket policies just constituted 6% of our APE. That's one of the lowest in the industry. So to that extent, we don't have any impact at all. And we have had similar situations in the past of tax changes for ULIP. And when we looked at our product mix post and pre that tax change, we didn't have any significant difference. So that goes to say that these tax matters are left to the government. I'm sure government is taking an appropriate decision looking at all the factors, but we should be ready to play within that. That's the way we feel. What is the best play to play within that? Have a full product suite, have a well-diversified channel mix, and take advantage of the great insurance opportunity in the country. So to that extent, I do believe that these are all some of the passing sort of clouds, I would say, and we will be back on track. And we are already back on track. So we are not dependent on any tax regime change or any specific incentives being given for our products. And that is the way we have run our business. That's the way we will continue to run our business. And the results you have seen across these last 4 years is really a testimony to the fact that a well-diversified channel and well-diversified product mix, how we can do wonders to the VNB development for a company.
Right. And where would all of this rather leave your margins, say 2 to 3 years from now? And how is it that your margins would evolve, you think?
Yeah, at 32% margin, VNB margin today, we are the best in class as of today. That's what I want to first lay out. And we are not single-mindedly focused on the margin. Margin to us is a derivative. We will focus on VNB development. And margin, whatever comes out of it in terms of VNB to APE, that becomes the margin. Having said that, I do believe that the margins can potentially grow in the medium term. Why I say that is because the protection, as we talked about, it's only about 17% of our business today because of various factors which I mentioned earlier. That 17% has a potential to grow to probably a quarter of our business over the medium term because there is a huge potential. And we are coming with a lower base because of the pandemic and the related supply side issues. When these things get sorted out as we move along, the protection can become a higher proportion of our product mix. When it becomes a higher proportion of our product mix, as I said earlier, it's a higher margin business, so it can push the margin up. However, having said that, we would be focused on growth, and growth has come back very strongly. If you look at the financials for 2023, and in the short term, the VNB development could be driven more by the top line, but in the medium term, I will not rule out any margin expansion, even from this highest level of margins in the industry.
Your distribution mix currently looks more balanced than what it did 4 years back. Which are your most accretive channels from a product and margin perspective, and would you look to change this at all?
Thank you for saying that. Yes, it is more balanced and more diversified, and thank you for recognizing that. So if you look at how the distribution can grow from here on, I think there is a huge opportunity in growth in terms of tying up with more banks as we go along. As you know, IRDA has recently opened up the corporate agents architecture. Thereby, they can add more insurance companies. And we, being a company already working with 39 banks, are in an advantageous position to get more and more banks into our fold. So that is one area where there could be a growth. Agency is already 26% of our business, and it's a granular channel, and the agents are looking for business, and we are recruiting, and we have expanded the agency force during the last year, and that will start yielding higher benefits as we move along. So I have a feeling that even in the medium, we will continue to have a balanced mix, growing both agency as well as banker, and to some extent the direct business as well. These are some of the channels which will lead the growth when it comes to APE. You talked about the margins of the channels. The way we look at it is that margin is more of a product specific than a channel specific. Depending on what product mix a channel picks up, the resultant margin happens. So we will focus on the products, and we will focus on keeping the products available across the requirements of the customers. And depending on the customer profile of the channels, whatever they pick up, that will give us a net margin. So that is the way we look at the channel product margin dynamics.
What would be your immediate targets for FY24 be? Growth in terms of VNB and margins?
So if I look at it from a potential perspective, I do believe that the savings line of our business can grow at the nominal GDP growth rate. So because we have seen a lot of market volatility last year, hopefully as we go along, things will stabilize. That could give us a little bit of growth in the ULIP segment. Similarly, other segments also can potentially grow, participating and non-participating. Given all this, I think the savings line of business can grow in line with the nominal GDP growth rate. If you look at protection, the group protection could be a bit stable because we have seen a tremendous growth in the last year, again driven by the pandemic. However, the retail protection is having a lower base. When I look at our own performance in the last 6-7 months, sequentially we have been improving the retail protection and we are sorting out all the supply side issues. So much of those issues are behind us. So I have a feeling that the retail protection will grow at a rate which is higher than the overall top line growth rate, which could be beneficial to the margins as well. So the growth outlook is, as I said, savings in line with the nominal GDP growth rate, protection a little bit higher than that. Margin outlook is stable as of now. That is what I can say. But we're not really articulated a specific target for financial year 2024. But this is the potential within which we will operate.
And soon you're going to be retiring as the new managing director and CEO is going to come through. Is there enough depth in the ICICI Pru leadership to continue the journey that you began?
Yeah, so when you look at the ICICI group, there is never a dearth of talent or any question about leadership depth at all. So even now we can see that as I retire, we have been one of the companies which have planned very carefully the succession, and Anup is going to be here. So if you ask me, what do I feel about the company? Very strong leadership depth, and the legacy will be carried on. So that I have no doubt about. You talked about Anup. Anup has been my valued colleague in ICICI Group and also my classmate in the business school. So I've known him for 3 decades. And more importantly, from a company point of view, he has been a non-executive director of the company for over 4 years. So I do expect a strategic continuity. And I have said openly in my analyst call to say that my team and I will ensure a very smooth transition. So there should not be any problem whatsoever. There should not be any concerns regarding the strategic continuity or a leadership depth of the company. And I can say that every time a new CEO comes, of course, he or she brings his or her own perspective. So that should be expected because each one comes with his or her own perspectives to the business and the agenda. Having said that, given that he has been on the board for 4.5 years, part of the strategy formulation, I see a strategic continuity. At the same time, company being taken to newer levels of value delivery to the shareholders. That's the way I look at this leadership transition.
Well, it's a really appreciate your time. So glad you could join us. I'm going to mark the markets for a minute. 2 points up for the Nifty, flat, but IT is coming back, which is very, very important. It's also important for me to point out that the market breadth has stabilized. Volume activity ahead of numbers, both in Reliance and ICICI, seems to be solid. But hospital stocks of late, or that sector, has seen massive amount of re-rating. Re-rating in terms of how the sector has moved, how health insurance is helping the sector per se, and progressively how P investors and global investors now are really looking at increasing their ownership in this large multi-billion-dollar opportunity, which is the per capita increase and the demand for the Indian healthcare sector. And let's take that conversation forward with none other than Dr. Ashutosh Raghuvanshi. It's been a while we haven't connected with him. There was a time we would trouble him almost on a daily basis to understand the update on the COVID. I'm so glad we are talking this time and we are not connecting and talking about COVID.
Thank you, Nikunj, for having me.
Actually, we should start with COVID, sir. Now that numbers have increased, I forgot about it.
Yes. Yeah, numbers have certainly increased, but it is not an alarming situation. Hospitalizations haven't increased. Most of the infections are self-limiting, though the numbers are increasing, but I think this wave should settle pretty quickly.
Glad to hear that. So glad to hear that. When we spoke to you last time, sir, you said Fortis is committed to reduce their debt. You were generating cash flows were moving in the right direction. So if the stated objective is to reduce the debt, why have you acquired an asset worth 225 crore?
Yeah, so our debt position has been continuously improving. We will be closing the year at a much better situation than what we started the year with. So the balance sheet is strong. And we need to look at growth, and we have always stated that we are looking for growth which is synergistic and which gives us more depth in the clusters in which we operate. So this is in line with that. This would give us another 350 beds in Gurgaon, where we already have a good presence, along with the brownfield expansion in our flagship facility. This would give us about 850 beds. And this will help us to serve the community, especially the newer parts of the city which are growing. So I think that this is very much in line with our stated strategy. At the same time, this is not going to be causing any stress on our balance sheet, because our balance sheet is very healthy. Our debt position has continuously been improving.
My understanding is that currently you do have a opportunity to go ahead with brownfield expansion, especially looking at your large hospitals and the kind of land which is there in the complex. Why are you not going for aggressive brownfield expansion?
No, Nikunj, we are very much on that. In fact, I am happy to inform you that the construction for 4 of our projects is already on. And some of the brownfield growth, which is to be done by commissioning new beds, which are already ready in Mumbai and Calcutta, are also ready. So that part is ready. Plus the construction at FMRI, Noida, Shalimar Bagh and Faridabad is on. So by the end of this year, we should have almost about another 250 beds added on the brownfield side.
Dr. Rangavanshi, this is a question which perhaps our viewers and your shareholders would like to understand. While the matter in terms of the open offer is something sub judice, so I'm not getting there. But because of this overhang of this open offer, has there been any change in the business disruption? Has there been any change in terms of what IHH wanted to do, but they're holding it back?
No, as far as our growth strategy is concerned, I think we have been very much on track. Focus in the first year was to get the cost structures right. Following that, we were bogged down by the COVID scenario for a couple of years. But post that, our plans are absolutely on track. All the brownfield expansions, a lot of physical infrastructure has been already added in last 3 years as well, especially in terms of medical equipment. A lot of large capital investment has been made in large diagnostic as well as therapeutic equipment. So that part has been completely on track, and we are absolutely as per our plan. Now, going forward also, this acquisition is part of that strategy, and we are looking for a little more rationalization of our portfolio. As you're aware that some of our assets probably have not performed as well as others. So we are focusing on improving those performance or taking other steps for that. But at the same time, the idea is to improve both profitability as well as achieve a growth which is again profitable. So this acquisition is very much aligned to the broad strategy.
Let me just clear the air, sir, and please correct me if I'm wrong. What you're essentially indicating is that while strategically there is an importance of the open offer to sail through, but in terms of a business progress and the strategy of the hospital, nothing has changed. And open offer is a strategic importance, but in terms of business activity, everything is going as a plan and everything is on track.
Absolutely. There are certain things which we could do a little more, but it is not stopping our regular operations. But if we were to look at some major acquisition or something, for that, we would probably face some constraints. But at the moment, we are very clear that we don't have much overhang of the legal situation which is there.
What you've reported and the growth what you've planned would have come irrespective of the open offer or not. That's what I'm trying to understand.
Yeah. I think we're getting it at whether we would be requiring further capital, and definitely some fundraising will have to be done, but we will do that at the right time.
Dr. Raghuvanshi, thank you so much for joining in. I wanted to get in your take as well now that we're seeing a rise in COVID cases coming in terms of just hospital preparedness and increased testing. I'm sure a lot of our viewers as well would want to know a little bit more about that.
Yes, so testing infrastructure is very much in place because of the previous experience. And the hospitals are also very much geared up to provide services and repurpose the areas which need to be isolated in case there is a need for that. So far, we are not seeing much hospitalization, so that part is pretty much taken care of. And what we are also noticing is people are not testing as often as they used to, for the simple reason that this is a very self-limiting kind of infection, which generally sort of recovers in a period of 3 to 5 days.
Okay, thank you for that. Dr. Raghuvanshi, I want to go back to the big picture again. Thank you, sir. There are a lot of M&A deals happening in the hospital sector certainly. I mean, it is on the top of the priority for PE investors. It is on the top of priority for sovereign investors. What has changed? I mean, a lot of PE money, which is considered to be tough money but long-term money, is now there.
No, I think you have given the answer there itself. Because of the long-term nature of the investment in healthcare, I think most of the funds find it very interesting. At the same time, in India, we still have a huge gap between the demand and supply. With the universal hospitalization, universal health coverage, which the government has been planning in phases, I think that will further give boost to the healthcare infrastructure. At the same time, the penetration of insurance is being very fast, much faster than what it was anticipated. So as a result of that, there will be huge demand for private healthcare. And that's the reason why long-term patient capital is seeking to get into healthcare. And that's the reason why you see so much of activity and so much of interest in the healthcare delivery space.
Dr. Raghuvanshi, for Fortis, the big uptick in the COVID time came from your diagnostic business. That business, A, the COVID testing is not there, has lost that business. Not that anybody should complain, but mathematically, yes, that business is over. B, it's a business where we've seen intense competition. SRL Diagnostics is one of your big businesses. It's number second or third in terms of the diagnostic chain as well. What is happening there?
You're right that a lot of tailwinds were there because of the diagnostic volume going up during the COVID phase. That has gone away. And the space has become extremely competitive. The new age players have come in, the digital first providers are there, traditional players are there, a lot of new players have come in from the pharma and other industries as well, because of the kind of attractive profile which this business had. And as a result of that, the overall growth rates have come down. But what we are seeing is that some of the deep discounting which was happening earlier on has gradually getting rationalized now. And as a result of that, I think there's some degree of stability is happening. The other thing to remember in the diagnostic business is that the organized sector is still relatively small and there is a large unorganized sector. So there is a lot of potential for that getting organized. So all these players would probably not do well, but some of them will do well, and the business will start consolidating. We are facing the same challenges as the rest of the industry at SRL as well. We are seeing that our organic growth, which used to be around 14-15%, has come down to about 8-9%. So that has been the case.
Growth in other businesses, medical tourism or planned surgeries, will they more than make up?
Yeah, so we look at the diagnostic as well as hospital separately. So as far as hospitals are concerned, the occupancy levels have gone up. The international patients have also gone up. Hospitals have more or less made up for the shortfall which has happened on the diagnostic side. But I think these two businesses have their separate dynamics, and it's important that we evaluate them separately.
For next 3 to 5 years, first the industry and then Fortis. What kind of growth we should expect? Mid-teens, mid-20s?
I think mid-teens is where we expect both the industry as well as our company to grow.
And how will next 3 years for Fortis be different from last 3 years? Last 3 years includes COVID. It includes a lot of cost rationalization. It includes a real drop in medical tourism. Next 3 years, how will they be different?
Next 3 years are going to be very exciting for us because we are looking to get all our brownfield expansion in place. So in next 3 years, about 1,400 more beds which are brownfield and which will have a kind of a rapid turnaround and absorption in the system will be ready. So as and when these beds keep on getting absorbed, we expect to see a much faster growth than what we have seen in last decade or so. So I think that would be a significant growth. If in terms of numbers, it is almost 35% capacity getting added, and that too being brownfield, it will turn around pretty fast.
And you are giving me this purely based on brownfield expansion that does not include any kind of an acquisition.
Yes, that would be a nice thing on the cake.
Just to wrap it up, sir, I will not be doing justice to this interview if I don't ask the update on the open offer. Legally, where is it stuck?
So our understanding is that there is no restriction from the Supreme Court side. So we are just seeking some clarifications, and based on that, IHH would decide on the next few steps.
So all the rumors that IHH is, they are slightly disappointed with Fortis. They are getting slightly edgy about what is happening to the legal framework. Can I dismiss all that? Are they fully committed? I mean, why don't you use this forum to clear the air?
Absolutely. IHH has been very committed and very involved with Fortis. And on the operational side, we have a lot of synergies with IHH. And as a result of that, I think both sides are extremely happy for this association and this parentage which we have with IHH. So I think there should be no doubt in anybody's mind about the commitment which IHH has towards Fortis. And they are not, all of us are disappointed with the pace at which these matters have proceeded. But definitely there is no disappointment as far as performance is concerned.
Yeah, trust me, the punchline I was looking for, that yes, the legal action will take its own course, but it is business as usual. And so good to connect with you, sir, and hope to see much more of you going forward.
Thank you so much.
Let's take a break. Fortis, ED no impact. Stock was down, now it's up. It's trading almost at the highest point of the day. I want to mark Tatacom. The stock went up 4% after the interview. You can proudly say that's an ED no impact. That's nifty for you. We'll look at Tatacom and then we'll take a break after that. Yesterday just shot up right after 10:30 when we played our interview with the CEO, Amul Lakshmi Narayanan. That's Tatacom for you, 1, 2, 2, 3. One of the rare IT stocks where the market have to understand that this is not just an IT company, it's a data company, and the trajectory for data and IT services, they are like apple and oranges. Let's take a break. When we come back, we'll capture some trading ideas for our viewers.